Hello and welcome to News Now. I'm Ankur Mishra. Let's get started with CPI data, which has come in for the month of November. Retail inflation for the month of November saw a marginal uptick at 0.71%. This compares to 0.25% rise in October, which was the lowest level ever seen since beginning of new series. Meanwhile, food inflation in the deflationary territory with minus 3.91% versus minus 5.02% in the month of October. To discuss this data, we have two important guests, Gaura Sengupta as well as Siddharth Sanyal. Welcome, Siddharth and Gaura. I want to come to you, Siddharth, first. With a number of 0.71% last month, do you think it is again in the anticipated lines?
Absolutely. I think in this particular month, the expectation was at around 0.7% only, and the inflation number came exactly in that zone. In terms of the basic components also, there is also not too much of a surprise. Now, we need to figure out how exactly going ahead the WPI trajectory pans out. But as of now, the CPI numbers absolutely bang on expectation.
Expectations as per Siddharth. Gaura, what is your reading of the numbers and particularly food inflation? There is slight, I would say, increase in food inflation, but again, this is still in negative territory, minus 3%, still well within the guidance which was given by Reserve Bank of India.
Yes, so as Siddharth said, this was completely in line with expectation. Even our estimate was around 0.7. Food inflation, the pace of decline is moderated a bit, but it's also a reflection of adverse base or less supportive base in the month of November. So that tends to impact the year-on-year numbers. But beyond food, what I wanted to highlight is if you look at core inflation, which is you remove gold and silver from core inflation, that has hit another fresh low of around 2.5% in November, a fresh historical low. So it's showing that there is a negative output gap in the economy. So from an inflation risk perspective, that shows that core inflation will likely remain benign with negative output gap in the economy. For the full year, we're still tracking at 2% for the year, FY26. Even next year is tracking close to 4%, which is in line with RBI estimates. So we don't see too many risks on inflation right now. Food, it's showing broad-based moderation. We saw a brief spike in tomato inflation, but that is now beginning to subside, so which is a good sign. Rabi sowing is off to a very strong start. We've got good reservoir levels. So the food outlook looks very positive.
Gaura, you mentioned about food inflation, and I want to understand from the next month onwards, specifically in the next quarter per se as well. Do you think the base effect will come into play and the slight increase in the inflation is expected, or you think the pace of the moderation which is there may be uneven?
So definitely the base effect starts waning. The support from base is maximum in our current Q3 quarter. We are tracking at around 1% or 0.9% for Q3. Then Q4 it goes to around 2.9, still very benign. Our headline trajectory hits around 4% in H1 FY27, where the support from base completely wanes. So, but still, it's for the full year FY27, we are still tracking at around 4.2, which is close to the 4% target. And yes, the support from the base is the highest in Q3, and it starts waning from there on.
Siddharth, I want to understand from you, the mandate of MPC is between 2 to 6%. Of course, the guidance which has been given, the projection for FY26 is 2%. Do you think there is a chance that we may miss that guidance as well on the lower side?
Well, we think that there is a possibility of that number coming slightly lower, but not significantly lower. So it will possibly end the year with an average of around 2% or marginally lower. But more importantly, what we get to see at this moment, from this point onwards, if we take about the next 3 to 4 quarters, inflation on an average will be around 3%, is what the forecasts say at this moment. Now, that means that not only the past about 9-10 months where we have seen very benign inflation at this moment more often than not, going ahead for the next close to 1 year also, if it stays around 3% on an average, even though that will mean that that stays within the 2 to 6% range, that is actually lower than the 4% midpoint of that particular range what the RBI targets. That actually leads us to a very interesting scenario about what is the call on the rate side that the MPC will be taking when they meet next in February.
Also, I want to understand from both of you, and Siddharth, with you first, now that series will be changing, the base year will be changing, how much of that impact are you anticipating?
Well, one particular thing will happen for sure is that the weight of food will possibly go down a little more. Some of the other new age consumption items will possibly be getting a slightly higher weightage like electronics, etc. Now, with food moving lower, irrespective of whether we see immediately a little bit of higher inflation or lower inflation, the more important thing will possibly be that the volatility or the fluctuations in the series you can expect eventually to be slightly less. It's not that it will be dramatically less, but given that it will be changing towards a lower weight for food, eventually it will reduce the volatility or the fluctuation in the series. I think that will be something very, very important. The weight of core will possibly see a little more. But I think in this particular context, Gaura mentioned a very important point that its core is also defined in one particular way. And precious metal like gold and silver is a part of that at this moment, which is contributing a very significant component of the overall core inflation uptick also, what we are seeing now. So it's important to continuously, not only, you cannot change the basket every now and then, but we analysts need to actually do that, take into account the fine nuances, and that will actually give us the proper picture on a steady state basis.
Right, Siddharth, and I want to come to you, Gaura, on the same question. With the change which is likely to happen next year, how do you think that the projections will be altered accordingly?
Weightage should go down. You'll see more weightage for core. They're going to add modern services like OTT, quick commerce. So we're not entirely sure. I'm sure modern services, when you'll include, it'll put a little bit of upward pressure on the services side. But the good news is, at least for FY27, because food price inflation has been so negative in FY26, what will happen due to base effect alone, food inflation will tend to rise in FY27. So the fact that the weight on food goes down under the new series will be a little bit beneficial on the margin. So it could have a very marginal dampening impact on the headline series for FY27 because food will tend to, go up in FY27. Core has remained elevated. If you include gold, it's around 4.4. So core will remain around similar levels even in FY27, though when they add modern services, they add, let's say, these various cap services, etc. So there should be some pickup on the services side. I think I'll be very keen to watch what is the impact on housing inflation, which has been under a lot of debate, which remains very subdued. It's tracking at 3%. And there's a lot of change in methodology, which MOSPI is going to do for housing and its impact. For example, we'll get rural housing now, not just urban. They'll also increase it to a monthly frequency. Earlier, they used to check prices once in 6 months because rental agreements don't change that frequently. They've made improvements in the methodology. So how does that end up impacting housing inflation is yet to be seen. But I think on the margin, it might dampen the headline inflation because with the lower weight on food for FY27.
Right. One last question I'll come to you, Siddharth. Now, with this data of inflation which is there for the monetary policy that we know that there is definitely 2 months to go. And but having said that, being in the same trajectory as anticipated, do you think that it will pave the way for the kind of atmosphere, the kind of trajectory which was set by Reserve Bank of India? Also meaning that can there be expectation of rate cut in the next monetary policy?
2 months or 7 weeks is a very, very long time these days. And a lot of things keep changing. But having said that, we have seen that inflation remains very benign at this moment. RBI has delivered quite a bit of cut, but they had not been shy. The MPC had not been shy to deliver a rate action, even when the headline GDP number is very high, if they actually see CPI number or headline CPI number at a very low level or a level which is below their target range. Now, it looks like that particular scenario continues. Most probably GDP number will continue to be a decent number, slightly lower, but a very, very decent number. Nevertheless, inflation stays very soft going ahead also, and even on a forward-looking basis. So very clearly, February meeting remains a live meeting, no doubt about that. And I think that's a very, very important factor at this moment.
Point well taken, Siddharth. Thank you so much for joining Gaura as well as Siddharth Sanyal. Of course, there is a lot of data which will be coming in between February and the meeting which had just gone by. With this, it's time to take a very quick break. And after the break, don't go away. A lot of news is waiting for you.